Welcome students who are taking financial accounting, and in this series of videos we are working on the Chapter 2 short exercises. And in interest of saving time, I had noticed that I was spending a lot of time repeating the same things in most of the videos. So I'm going to have less and less of a tendency to do that. If you're watching through these videos, you've already seen a lot of things, so I'm just going to start jumping right into things without being as repetitive as I have been in the past. Otherwise, it's going to take forever to get through this textbook. All right, so short exercise 2-3. The following list names activities involved in the accounting process of recording and summarizing business transactions. Place the number corresponding with the order the activity occurs next to the activity, starting with number 1. So what this means is, it's how does the accounting process go? If you watched the last video in the theory videos, you saw that there was step 1, 2, 3, 4, 5, 6, 7, and 8. It was a circular kind of thing, and that's what they're referring to. Where are you at in this process? In other words, what sequence of events are occurring. So the first thing that happens is the transaction occurs. Well, when the transaction occurs, what's the next thing that we have to do? Well, the next thing we do is we record the transactions in a journal. So that's number 2. Now, once they're in the journal, we need to post the transactions from the journal to the ledger. So this is number 3. Okay. And once they're posted, okay, we can create balance in the ledger accounts. Remember, when we take information from the journal and we put it into the ledger, all we're doing is rearranging information into like categories, the ledger accounts, cash, receivables, payables, so on and so forth. But you can have an account, and notice that I'm using a T account here. Let's call it cash, right? I can have, all of these here transactions, okay, but I don't know what the balance is until I figure it out. I add up my debits and I add up my credits, and then I subtract one from the other to find whatever my balance is. So I get the balances in these ledger accounts, and that allows me then to next prepare a trial balance. Remember, the trial balance is nothing more than a listing of the general ledger accounts. You get those from the chart of accounts, which is just like a table of contents for the ledger accounts. So they're a listing of the ledger accounts and the balances in those accounts. And once you have the trial balance, okay, you have these balances in the accounts, and you use those ledger accounts in order to create your financial statements. So 5 would be the preparation of the financial statements. Okay, that's the flow and the process. Right, next problem, 2-4. For each of the following accounts, indicate the account type by labeling it as an asset, liability, equity, revenue, or expense. Also give the digit each account number would begin with in the chart of accounts. Use the most detailed account type appropriate. Okay, so if you recall from the theory videos, we have assets, liabilities, equity, revenue, and expense. And the numbering of the ledger accounts follows that order. All assets begin with a 1, liabilities begin with a 2, equity begins with a 3, revenue begins with a 4, and expense begins with a 5, regardless of the numbering scheme. Small businesses might have only 3 digits, okay? Sometimes 4. Something like the American Red Cross actually has 7 digits, a hyphen, and then 5 more. Okay, and they're alphanumeric. But regardless of the account number, that first digit, okay, if it's an expense account, it's going to begin with a 5. Okay, doesn't matter how many digits come after. All right, if it's a liability account, it's going to begin with a 2. Okay, doesn't matter what comes after it. All of the categories in the accounts begin with, all of the accounts in that category begin with whatever number for that particular account. So in the case of land, land is an asset. All right, why? Because you own the land, and we begin, all assets begin with a number 1, so that's why they put A1 here. Okay, service revenue, that's a revenue account, and that begins with a 4. Dividends from the previous problem 2-2. Oops. We had discussed the idea of service revenue and dividends. So go back and watch that video if you're not understanding why the service revenue is R4 and dividends is going to be stockholders' equity, which is a 3. Go back and watch problem, short exercise 2-2 for an explanation about dividends and the service revenue. Accounts receivable is something we own because why? People owe us money. We made a sale and it was on account being on credit. So we extended somebody credit, and that means they owe us the money. For them, it's a liability because they owe us. This is us, and this is them. Okay, this is the customer. Okay, they owe us money. So for them, it's a liability. Okay, but owing us, that's an asset for us because that's something we own. We own that income, that cash that's going to come to us. So that's an asset, and that would be A1. Salaries expense. See the word expense, it's an expense. So X, well, I'm going to put E. So this should be stockholders' equity like that, and this would be a 5. I use a different naming convention because I don't like the stockholders' equity because not all stockholders' equity is equity. Like I said, sole proprietorship is just called, owner's equity or just plain equity. So I'll try to keep with what's in the book here, but realize I use this convention here. Notes payable, you see the word payable, it's a liability. So that's, 2. Common stock is an equity account, right? So that's stockholders' equity, 3. And then rent expense, you see the word expense, that's going to be a 5. Okay, right, 2-5. Demonstrate your knowledge of accounting terminology by filling in the blanks to review some key definitions. Dylan Baker is describing the accounting process for a friend who was a psychology major. Dylan states, the basic summary device in accounting is the account, or the general ledger account. That's G/L is short for general ledger, so it would be general ledger account. Account or general ledger account is acceptable for that answer. The left side of the account is called a debit. Remember, the definition of a debit or the definition, and it says here, and the right side is called a credit. Right? The definition of a debit or the definition of a credit is not increase plus or minus, increase, decrease, plus, minus. It's not that. It all depends upon that relationship between with the category of account and the normal balance. The normal balance is what increases that category of account. Okay? What increases that category of account, and what increases, the what in what increases is whether it's a debit or it's a credit. Okay? So a debit in one situation could be an increase, but in another situation it could be a decrease. So you don't have a definition of plus and minus, increase or decrease for debits and credits. The definition of a debit is what's on the left. The definition of a credit is what's on the right. We record the transactions first in the journal. Then we post or copy the data to the general ledger accounts. Okay. So it could be, you call it to the general ledger accounts. The solutions show T accounts. I don't like the idea of a T account because the T account is a tool, okay? So I would, even though that's an answer in the book, I would have a tendency not to include that as part of the answer. It is helpful to list all of the accounts and their balances on a trial balance. And just like for general ledger, we abbreviate G/L. Trial balance, we abbreviate T/B to represent the trial balance. And again, the trial balance is nothing more than a listing of the general ledger accounts and the balances in those accounts. All right, so okay, I'm on 6, and I'm at 11 minutes, so I'll work through this one, and then we'll jump into another video. Right. For each of the following accounts, indicate if the account's normal balance is a debit balance or a credit balance. Okay, remember, the normal balance, which I represent with the symbol of plus sign, means what increases that category of accounts. So remember, a category of accounts are assets equals liability plus equity. That's on the balance sheet. Okay. And on the income statement, we have revenues minus expenses. Okay. So the assets, liabilities, equity, revenue, and expenses are the category. The normal balance is what increases that particular category of account. And the what that increases is either going to be a debit or a credit. And if you watch the theory videos, the mnemonic, the visual representation was I created a T account where this equal sign is. And the definition of a debit is what's on the left. So we know that for assets, we increase an asset on the debit side. For liabilities and equity, it's on the credit side, okay? Because it's on the right-hand side of that T account or as part of the accounting equation. Revenues are a credit and expenses are a debit. Why? Because generally, you're not in business to take a loss. So more often than not, your revenues are going to be greater than your expenses, okay? So that means you're going to have a profit. That profit is a credit because your revenues are a credit, okay? Now, if you have that profit, that gets closed out to equity. Well, notice that the credit increases on the equity side. So by having revenues being a credit and that profit, if I had equity of say 100,000 and I just had a profit of 10,000, right? Well, I'm increasing my equity to 110,000, which is a credit because I'm increasing on the credit side, okay? So that's why revenues are a credit. So that's the theory behind normal balance. It's what increases the category, the what being a debit or a credit, right? So we look at the accounts here, and an expense account, I just erased all of this, sorry, but I'll recreate it. Assets equals liabilities plus equity. So this is debits, and this is credits. And then we have revenues less expenses, okay, because it's a profit or a loss. So revenues are a credit and expenses are a debit. So rent expenses, a rent expense is an expense account, and we increase that on the debit side. Accounts payable is a liability account, so we increase those on the credit side. Service revenue is a revenue account, that's on the credit side. Office furniture is something we own, that's an asset. Okay, notice what I'm doing. I'm looking at the account and I'm asking what category of account. Office furniture is something I own. What I own is an asset. Then my normal balance of an asset is a debit. Notice the relationship there, okay? Don't memorize this stuff. Pay attention to the relationship. After doing it some time, it's going to be very easy. You're going to internalize it, so to a certain extent, you're almost going to memorize it. And in a lot of cases, it will be memorized. But realize that you're going to come across situations or circumstances where it's going to be new and you're going to have to figure it out. Well, just like you had to figure out or know the concept behind the most simplistic thing like cash, Even though you memorize cash as an asset and you increase cash on the debit side, when you have a new account, you're going to have to think through that same simple process in order to be able to figure it out. So don't just memorize, understand the concept. Common stock is an equity account, all right? And we increase the equity on the credit side. Land is something we own, right? So that's like, office furniture in that land is an asset, and we increase the asset on the debit side. And then dividends, we've determined that from the previous video, from the previous exercise, that we're going to say dividends are equity, and we increase the equity on the credit side. Okay, so I'm going to stop here and pick up with the next problem in the next video.